Welcome to Business Owner Bootcamp, the Wealthspire Advisors podcast designed to help business owners and entrepreneurs take control of their finances. Hosts and financial advisors Michael Delgas and Sandy Wiggins break down key topics like tax strategies, exit planning, business valuations, and real-world experiences with expert guests. And now, here are your hosts, Michael Delgas and Sandy Wiggins.
Good afternoon. My name is Sandy Wiggins. I'm Managing Director of the Richmond, Virginia Wealthspire office. I'm happy to invite you to the next 30 minutes to listen into the Business Owner Bootcamp. The purpose of our podcasts are to bring topics of interest and importance to business owners thinking about growing their business, managing it, optimizing it, and hopefully someday selling it or transitioning it to future leadership. So today we've got Chris Maxey. He's our Chief Market Strategist at Wealthspire. And our discussion today is going to focus on investments for sure, but like most topics we talk about on the Business Owner Bootcamp, tax is going to be an important part of it. So welcome, Chris. Thanks for joining us.
Yeah, absolutely, Sandy. I'm glad to have finally gotten the invite to join you for the conversation. And I know next 30 minutes we have some technical things that we're going to be talking about, but very applicable for the audience. And, it's one of those areas that's always an evolution. So I look forward to trying to unpack it over this conversation.
Great. Well, let's kick it off and let's focus on a transition, right? We're thinking about, we're a business owner. We've identified a potential buyer. We're beginning to think about the transaction. But let's also add to that mix investment strategy. So if you don't mind, share a little bit on the front end about the critical planning moment as it relates to investment strategy and tying that into a potential deal.
Yeah. So I know this is something that you think a lot about with the clients that you're working with. On the investment side, a lot of the conversation boils down to what are you going to do with all of this money once it arrives? And for so many of the business owners that we're working with, that I know that you work with every single day, they tend to push that decision off because they're so focused on the transaction itself. They're so focused on thinking about, okay, I've been building this business for potentially many years or decades, and they haven't given as much thought to, okay, the money is coming in my direction. Now, what do I do with it? As I know you've experienced and seen quite often, it is a bit of a mistake to wait too long on making that decision and to start the planning process. As we're thinking about the investment portfolio, there are so many things that need to happen ahead of a transaction occurring. Whether it's putting a plan in place, whether it's thinking about what investments could be advantageous ahead of the transaction to potentially help you with some of the tax ramifications, and we'll talk about that today. But there has been this tendency from what we've seen for so much of that personal planning to occur as the transaction is closing or after the transaction. And I'm here to tell you, as I know you've been sharing for a long time now, that's a mistake, right? The sooner that you can begin to have the conversation, put a plan in place, the more beneficial it is for everybody. And I know that's one of the things that you've experienced quite a bit over the years as well in the clients that you're working with.
Yeah, and so you're right. The portfolio that a business owner might have today might have served them very well leading up to the transaction, but likely a different set of tools, a different perspective needs to be applied to a post-deal portfolio. A lot of that also has to do with the liquidity that's generated and the need of that capital to sustain the individual, the family, the community, whatever their goals are. And that's a lot different than the cash flow that comes out of a business. So tax is something that I mentioned and you have alluded to. When we're approaching a deal, there's likely going to be a significant capital gain tax as a result of the transaction. And one strategy that we use post deal and even leading up to a deal is something called direct indexing. And we'll talk a good bit about that today. Would you mind just kind of giving our audience a primer on direct indexing and how it's used to help on the tax front?
Yeah, of course. This is something that, ironically has been around for a long time, but people haven't necessarily heard about until recent years. As you think about business owners, they're so focused on the business and building a business and growing it. A lot of their wealth winds up being very concentrated in this single asset that they have ownership of. And as you're beginning to want to make the decision to move away from concentrated ownership to something a little more diversified, that's where direct indexing comes into play. You can go back all the way to the 1970s for the origination of direct indexing. It really grew out of the institutional community with people opening up separately managed accounts. And there's a lot of acronyms, as you know, that get thrown around in our business. But at the end of the day, something like a separately managed account simply means that someone will own individual securities and manage those on your behalf. And you get to still have ownership of that pool of assets, but you have it on an individualized basis, unlike a mutual fund or an ETF. So you can go back all the way to the 1970s and that SMA world on the institutional investment community to see where we have grown from to where we are today. Direct indexing is simply saying, I want to own an index of securities, and that could be the S&P 500, it could be the Russell 1000, and I want to own all of the securities underlying it. Right. So when you're thinking about the S&P 500, ironically, there aren't exactly 500 securities in the S&P 500, but the goal is to replicate that basket by owning everything underlying it. So you may own the vast majority of what's in that index, and you're going to have that in your own account. Direct indexing says, let's buy all of those things and think about a way to make it a more tax efficient experience. If you have a stock that's up one day, you're probably going to have another stock that's down at that same point in time. So as you build a direct indexing strategy, it allows you to realize the losses to offset some of the gains. And at the end of the day, what you're trying to deliver is the experience of the index without the same potential tax implications and ramifications.
And one term that we often use is tax harvesting, tax loss harvesting. And that's really the fundamentals of direct indexing that you're describing, a recurring process of looking for losses, capturing those to use them to offset gains. And the gain in this particular discussion right now is focused on the gain in the investment portfolio, but it also can be used to offset gains outside of the portfolio, i.e. a sale of a business.
Right. And that's why this becomes so important. But the importance grows in terms of the planning and doing this ahead of time. Because if you know you're going to sell a business in 6 months' time, and in one day ahead of that transaction taking place, you say, okay, let's open that direct indexing strategy. Let's start to accumulate losses. Well, you don't have a lot of time to make that happen. So the sooner that you can begin the process, the better, because it allows you to front load the losses. It allows you to build up a budget of them, if you will, that can be utilized against the asset. Now, of course, it requires that you have capital available to do this. And there's a couple of other things that we'll talk about throughout the conversation, but the sooner the better, right? As with most things in life, the sooner you do it, the sooner you start working with Sandy and putting that plan in place, the better off you're going to be, because it does allow you to build up that budget of losses that can be utilized. The part here that introduces some complexity is you have to watch that portfolio every single day. And when I'm saying you, I don't mean the individual with the assets. I mean Sandy, right? Sandy has to sit there and watch that portfolio every single day so that we ensure we're harvesting the losses when they're available to us. Because if you're not doing it every single day, you're going to miss out on opportunities. And sure enough, that loss will no longer be available in a couple weeks' time or in a few months' time. So it's something where you really have to be watching the portfolio every single day. And we try to encourage people not to watch their investment portfolios every day. This is one of those situations where it does actually benefit you to look on a day-by-day basis.
And the evolution of separately managed accounts and this concept of watching the portfolio, on a minute by minute or daily basis, it really has led to the evolution of a broader use of direct indexing, and technology is the backbone of all of that. So maybe talk a little bit about, not getting too deep or techie, but that's a really important part of this puzzle.
Yeah, where we are today is starting to look quite a bit different than what people were even doing a decade ago. And the rise, the adoption, the introduction of technology is playing such a big role, but also the growth of financial assets and portfolios, right? The S&P has done really, really well in the last 10 years, and people are thinking about how do I potentially start to bring down my equity exposure without paying as much in the way of taxes? Well, where does technology come into play? It's because as you think about something like a separately managed account, it used to be that you couldn't buy fractional shares. So if you wanted to go buy a share of Berkshire Hathaway, or you wanted to buy a share of Nvidia when it was trading at a couple $1,000s, you wouldn't be able to buy only a portion of a share. You had to commit to buying a full share. And as you think about investment portfolios, and when you're trying to buy several hundred securities, well, that gets to be expensive, right? You can start to do the math and say, I need at least a few $1,000,000, if not more, to replicate that entire index. Nowadays, trading costs have come down. So when you work with a custodian, the trading costs have come down over the last 30 years. And in addition, they're now able to transact in fractional shares. Those are two pretty massive developments that weren't available to us even a decade ago. And that's allowed us to start moving forward where tax loss harvesting is a lot easier to pull off. You can buy fractional shares. You can set up separately managed accounts at lower minimums than what would have been available in the past. And so all these things have started to come together because of technology and because of the ease of implementation, and created a much larger universe of clients that can now tap into direct indexing strategies. Now that opens the door for what's the next step of this? What's the next stage? And I know that's where we'll go next, but long short, if you like a few losses, you're going to love a lot more losses, and that's what we're going to see.
Yeah, and neither of us are CPAs, and we don't claim to give specific tax advice, but it is worth saying when we talk about the losses that are generated, and you spoke a moment ago about accumulating them over a period of time in order to offset a transaction for the sale of a business. It's important to note that you don't lose those losses. There's a carry forward process. So you accumulate losses over, years, and that can be used in the future. And so this is a really, really helpful strategy from a tax perspective. And you talked about replicating the return of the S&P as an example. What in good years, utopia is we get the return of the S&P, and we actually get something called tax alpha, which gets us a higher net return on a tax adjusted basis. Maybe touch base on that concept of tax alpha for a moment, if you can.
Well, you bring up a great point, which we neglected to mention, or I neglected to mention, that the losses are able to be carried forward. But one other really important point is that, as we think about investment strategies, we don't invest simply because of tax benefits, right? When we're thinking about building an investment portfolio, when we're thinking about putting clients into portfolios and building around their assets, it's because we think it's a good investment idea. And then secondarily, if there are tax benefits and advantages, that's great. But we're never thinking with taxes first, investment second. We really want to make sure that we lead with good investment ideas and then the tax benefits on top of that. Now, as you're thinking about planning with clients, of course, I know taxes are always a consideration. So when you're talking about tax alpha, the idea is simply that when markets are more volatile, and that tends to happen as markets are going down, you're actually going to realize more in the way of losses. And we saw this happen in early of 2020. This also took place in 2022 when the stock market was struggling with the idea of higher interest rates and higher inflation. And that allowed managers that we're working with in those separately managed accounts to find additional losses within portfolios. And so the idea is, as the markets are going down, yeah, that's not great from an investment standpoint. We don't like to see portfolios declining in value, but let's find a way to take that negative and turn it into a positive. And the way you do that is with tax alpha. So simply saying, all right, this stock is down today, and there are some specific examples. I'm going to sell out of that stock. I'll rotate into something that is very, very similar. It'll give me a similar outcome and a similar experience. But I'm now going to take that loss and we're going to book it. We're going to have it as part of the investment portfolio. That's where your tax alpha comes from. So it's really this idea of harvesting those losses throughout the year, as we mentioned earlier, and being able to take those, carry them forward. It happens most frequently when markets are down, markets are volatile, and that's when we see the greatest activity taking place. Another example of this was April of 2025. The markets were very quickly selling off, almost too quickly, frankly. And there was an opportunity here to realize those losses. But when you got to the end of the year, the S&P had finished up more than 17%. So you were able to still have that same return, that same outcome. But now you had those additional losses that materialized in that March and April timeframe that could be utilized for other capital gains that were elsewhere within your portfolio.
Yeah, that's great. Thanks for making that clarification. And you've spoken about the S&P 500. You mentioned the Russell 1000. Maybe spend a moment on, excuse me, the blending of various benchmarks, because as you said, this is not driven by tax. We first want to make sure we've got a great investment strategy, and then we want to optimize it from a tax perspective. We're believers in diversification, and the S&P 500 is broadly diversified, but it doesn't cover all the equity asset classes. So maybe touch on the concept of how we blend various benchmarks to get that perfect mix for the right client.
Yeah. Well, I would love to build perfect portfolios, Sandy, but as with everything in life, it's hard to build a perfect portfolio. We try to build a very good one, certainly. But the reality at the end of the day is that perfect is defined by the individual, and all of the clients that we're working with, whether business owners or otherwise, have unique needs, which is one of the difficulties of the seat that you're sitting in, right? There are very unique circumstances for every client that we're working with as to what they're trying to achieve, what they want to do with their money. So as we think about how we build an investment portfolio that does incorporate direct indexing, it doesn't have to strictly be the S&P 500. And, that at the end of the day was the point you're trying to make. There are opportunities to add in small cap stocks, mid cap stocks. You can add in international. So there is a very big universe. And the reason that universe has grown is because of what we were talking about earlier. It's just simply this implementation of technology and the trading barriers having gone down over time. The frictions are lower today, which is always a bit of a good news, bad news situation. Yes, frictions are lower, and that opens up a wider universe. You've always got to be careful, though, about the trade-offs and the things that you're doing. So as you think about international stocks, for instance, it's a little bit trickier to implement a strategy like this because you may not be able to own all of the things that you want to, right? When you're thinking about ordinary stocks on the local stock market versus ADRs. So ADRs are the U.S. equivalent of what's available overseas and what a U.S. investor could trade, right? There's a lot of technicalities that begin to get involved, and so you have to be careful about where you're going. But that just goes back to this idea that everyone's circumstances are different. So Sandy, you working with an individual are going to identify those unique circumstances and try to lean into the parts of the market that are most beneficial for their portfolio. At the end of the day, that could be large cap U.S. stocks. It could be value stocks, it could be growth stocks, it could be international. But that's where we have to sit down with people through the planning process and make that determination to figure it out.
And some of our audience may be thinking about this question as we're talking. Can we do direct indexing with bonds?
Technology has brought us pretty far. It hasn't brought us as far as maybe we would like to, but that's a great question. What I would tell you there is there are some ways for that to occur, but realistically, tax loss harvesting in a bond SMA is not going to deliver as much value as it would in an equity SMA. The primary reason is because of how much volatility there is on the equity market side versus what we see in fixed income markets, right? When you're buying a bond, it's a contractual obligation that says, Assuming that individual or that company doesn't default, it's just going to simply pay back what the coupon is at maturity date plus the principal amount. So there's not usually quite as much to realize in the way of losses on the fixed income market. Of course, there are extraordinary years where that hasn't been the case, like 2022. And we did work with bond managers to undertake a very similar exercise at that time. But realistically, equity markets are where the opportunity is because of the volatility. You don't have 20% sell-offs like we did in April of 2025 in the bond market. It just usually doesn't happen that way.
Yep. And so the answer there is, again, taking the right tools for a given client circumstance. And it may involve direct indexing. It may not. It may have a tilt towards dividend paying stocks. We may have bonds for income, but that's the tailoring that goes on top of the overall strategy. And tax loss harvesting and direct indexing are just a tool that we use when it's appropriate. And again, oftentimes it does come in handy when we're dealing with a business owner, and there is a tax consideration sometime down the road. It's also worth mentioning that we use direct indexing outside of transactional related clients. It's a very good tool because it's a great investment, as you said earlier, and it's very efficient from a cost and tax point of view. So let's transition a little bit and talk about the evolution of direct indexing. You talked about SMAs, separately managed accounts, being introduced to on a broader scale in the early 70s. That evolved to direct indexing that was becoming really widely used over the last few years. And over the last 2 or 3 years, there's a new opportunity that complicates things a bit, but also adds some additional opportunity. So let's dig into that.
Yeah. So people have always said, I like a few losses, but if you can give me even more losses, all the better. And what we're beginning to find out is there are ways to do that, ways to deliver that. What we've now begun to hear about in the last several years, which you were talking about there, is long, short, direct indexing. So if you think back to the early 2000s, right through 2008, hedge funds were very popular in high net worth communities. So people loved this idea of going long and short certain securities. And so hedge funds were one of those de facto ways for family offices to get that exposure, for ultra high net worth investors to get that exposure and drive outperformance. Because if you can outperform on the long book and you can outperform on the short book, then that will naturally lead to you protecting capital when markets are down and driving outperformance when markets are up. That experience got to be a lot tougher after 2008 for a variety of reasons, but there was a pivot that happened a couple of years ago, which people started to work on. It was that idea of long-short direct indexing. So could you take a direct indexing strategy, add some leverage, add some shorts, and what are you able to deliver now? Additional losses. And this is a great strategy for business owners in particular, because as you start this a little sooner on, you can now really accumulate those losses ahead of time, ahead of a transaction taking place. And it allows you to scale them up. So what you're doing is essentially taking that long book, making it a little bit larger. In certain cases, you might own what's called 130% worth of exposure, and then you have a 30% short position. There are some very technical aspects here that we'll probably avoid for today's conversation, but we'll love to chat with people about if they're interested. The whole idea, though, is to add additional losses, because at the time of the transaction, you can now utilize those for the benefit of the transaction. So we see this being systematized now. Managers have great delivery mechanisms for people to be able to do it, and it's something that will only become more popular as we go forward.
Yeah, you said it well. It's complicated. We're not going to dig into that today, but it is certainly something that we want our audience to be aware of, to inquire, to learn about as they figure out what their path forward is, not only from an investment point of view, but from a tax point of view. With most things, there's the positives, and we've spent most of our conversation today speaking about high level what those are. What negatives exist, if any, on just the straightforward custom indexing or the long short custom indexing?
Yeah, there are complexities that come along with this, right? As we think over the last 20 years, people have been simplifying their investment lives. They've been putting more into ETFs because it's easy, it's simple, it's almost like hitting that simple button. But as you now start to think about direct indexing, it adds complexity because what's going to happen when you log into your brokerage account, you're now going to see hundreds of securities. And for a lot of people, they say, wow, that's just a nightmare. How do I keep track of all this? Again, that's where Sandy comes into play. We've built reporting systems that are designed to simplify the reporting around your brokerage account and make that a bit more seamless. But when you log in, you're going to see hundreds of securities. And for a lot of folks, they say, I just don't want to deal with all of those statements. I don't want to deal with, potentially seeing proxy votes that are going to come through my account. I don't want to have to deal with one thing after another from owning hundreds of individual securities. So what we would say to that is totally understand, totally appreciate simplification of investment lives and portfolios is great, and we're all for it. This delivers enough value, in our opinion, in our mind, that it's totally worth doing. The other point to keep in mind is that losses are not going to be able to get realized forever. So when you're thinking about a direct indexing strategy, at some point you are going to extinguish losses from a portfolio, and that's particularly true for a long only portfolio. So what the math shows us is that about year 7, year 8, you begin to run out of the opportunity to keep realizing losses unless additional cash is put into the portfolio. But that's once again where long short indexing comes into play, because it's allowing the opportunity to extend out the life of loss realization. And you could potentially see that last for a decade to 2 decades longer. So there are ways to handle all of this. But, at the end of the day, what I would say is the complexity is a bit challenging for some people because they don't love seeing that many line items within their brokerage accounts. And we totally get that.
Yeah, and again, I think it goes back to your comment about not letting the tax tail wag the dog. If a straightforward, simple ETF portfolio gets the job done, great. They're low cost, they're tax efficient. If you've got more complexity and an appetite or a willingness to deal with some of the complications that go along with long, short, and just traditional custom indexing, it's very much worth the exercise. I'll also comment again, you mentioned hedge funds were very effective they're still very effective. Oftentimes they create K1s versus 1099s. It's worth saying custom indexing does not create that K1. It's still the straightforward 1099s that you get just like on your other publicly traded investments. So I've had that question a couple of times come up. Is this going to slow up my tax prep because I'm waiting on a K1? Nope. It's 1099 and you're off and running. We've got just a few more minutes, Chris, and we've spent most of our time talking about direct indexing. Still with that lens of a great investment strategy while also considering tax minimization around a deal, what are some other things that we want to leave our audience with that we'll probably cover in future episodes? Let's just tease them a little bit with 2 or 3 other
Sure.
things that they need to be thinking about.
Yeah, the number one question that we often ask people, are you trying to hedge this concentrated asset, or are you trying to reduce your tax bill? So there's 2 different avenues that you can head down depending on what the answer is to that question. If you're trying to reduce the tax bill, we would really want to talk about things like direct indexing and now the offshoot of long short indexing. If you're trying to hedge a concentrated stock position, so perhaps you were the beneficiary of having purchased Apple or Nvidia 20 years ago, and all of a sudden it's grown to be a large part of your portfolio, then that takes us a different route. So when we're thinking about the opportunities there, we'll focus on the second one, which is trying to bring down that tax liability. that's where opportunity zones come into play. So we had opportunity zones that were originally introduced around 2017 as an opportunity for people to reinvest in real estate. So you take capital gains, you put it into a real estate investment, and this is the type of real estate where there is nothing pre-existing on this ground. So you're trying to build from the ground up, and what ultimately came of it was that you were able to defer your capital gain, so you didn't have to pay in that given tax year, and your appreciation occurred without additional gain on a go-forward basis. Those were pretty beneficial outcomes for a lot of folks. Opportunity zones began to wind down and were no longer as prominent because the legislation started to sunset. All of a sudden, they came back to life, and they're getting reintroduced in 2026. We'll see in the second half of the year that now becomes an opportunity all of a sudden again. That's one avenue. When you're thinking about things like paying the tax bill, it's as simple as what we've spoken about before, Sandy, which is cash management. How do you set aside the money and earn some income along the way before you have to pay the tax bill? We know when that's going to be due. We have a very set timeline. There are cash management strategies that we can put into place to help people out, earn incremental income that will be able to meet that tax need when it does arrive, or that tax liability when it arrives. Those are important ones. On the concentrated stock side, there are a number of innovative things that we can do with options markets. As an example, there are exchange funds out there. And so when you think about it, at the end of the day, there's a whole schematic of routes that you can follow depending on what you're ultimately trying to solve at the end of the day. Those schematics get very complicated depending on how far you want to dive into the rabbit hole.
And again, that's just, we want to have as many tools at our disposal as we can. And you've listed a few right there pretty quick. With what we've touched on today in our conversation, are you aware of any misconceptions or, an opportunity to refine our audience's perspective on what we've talked about topic-wise?
The one I would mention is that this doesn't allow you to avoid taxes altogether. So, you are going to have to pay taxes. As much as I know a lot of folks would like to say, I'm selling a business, I don't want to pay any tax whatsoever. Realistically, you can't take the tax liability down to zero. And the perspective that we've tried to share with people is that this is a good problem to have. It's one that we can help you with, that we can be very beneficial, throughout the situation, throughout the planning process. But we can't take the tax liability to zero, right? That's simply not going to be possible. We can work with people to derive really great outcomes and to help them take a very concentrated set of assets into something that is more diversified, and to preserve that wealth for the future needs of the family, of the individuals, of the next generation. But we're not going to be able to take that tax liability all the way to zero, right? That's just not possible. Unless, Sandy, maybe you found the golden ticket that I haven't turned over yet.
No, I'm still looking for it. But you bring up that concept, and there's a gentleman that generated a lot of very favorable one-liners related to tax. He was an appellate court judge in the 1920s, I think, named Learned Hand. And he was quoted as saying there are two tax systems in the U.S., one for the informed and one for the uninformed. And as I've said, we're not CPAs, we're not attorneys, but our job is as much about understanding a client's situation. Obviously, investments is a big driver there, but tax comes into every discussion that we have 9 times out of 10. So we want to inform our clients. We want them to be aware of the factors, the considerations. And so you reminded me of that quote. He also said it's every citizen's constitutional right to pay as little tax as required by law. And we're not, pushing the envelope. Everything we've talked about today is vanilla in the grand scheme of things when it comes to tax. But it's a matter of being aware of these tools and using them when they're appropriate.
Yeah, I think that's exactly right. It's about awareness. A lot of people would say, hey, this is just some sort of gimmick that you're trying to put in front of me. And at the end of the day, it's not a gimmick. It's very straightforward portfolio construction building that we've been able to implement at larger scale simply because, again, going back to technology, like we could not have done this 20 years ago in a scalable way. And I don't think anybody in the industry could have. But that's all changed pretty rapidly in the last 20 years. So it's not gimmickry at the, at the end of this. It is portfolio construction, making intelligent portfolio construction decisions, and then trying to smooth out that tax liability where possible, and just being informed and aware, as you say.
Yeah, well, if you wouldn't mind leaving our audience with this, based on our conversation today, what's the one takeaway? If we had to leave with one pearl of wisdom, what would that be?
It's don't forget to start planning your own personal financial assets at the same time that you're focused on your business transaction. Because if you try to do the business transaction first and then worry about your own assets afterward, it's going to be too late. That's it.
Well said. And that's been repeated in just about every episode we've had. Prior preparation prevents poor performance, and those 5 P's are important with regard to every aspect of your financial life. You're running your business, running your investment portfolio, and so starting sooner rather than later and engaging with the right people really can have a significant impact on your transaction, your wealth, and ultimately your financial future. Chris, it's been a pleasure. I'm sorry we're out of time. It went so quickly. I'm sure we'll have you back and we can talk about opportunity zones and some of the other tools that you mentioned. Again, thanks so much for joining us.
Yeah, I look forward to it, Sandy. It's always great to visit with you, and can't wait till we do it again.
Sounds good.
Thanks for listening to this episode of Business Owner Bootcamp, presented by Wealthspire Advisors. If you have any feedback or questions, including suggestions for future topics and guests, reach out to your hosts or send us an email at clientrelations@wealthspire.com.